Robert, I think I'm just sort of curious if this signals anything to the market, or if companies look at Apple and think, you know what, Apple's in a league of its own, that we can't take cues from this to signal the rest of the credit market. How do you think about that?
I think you can. Listen, the question people should be asking today isn't why is Apple borrowing? The question should be, why aren't they borrowing more? $5.5 billion to Apple. It's a relative rounding error relative to their balance sheet size and investor demand. The floodgates for borrowing have effectively been closed in the first half of the year as rates have risen, inflation fears have risen, and worries about a recession have risen. But some of that's starting to go away, and certainly, from a rate perspective, it's declining, and from a credit quality perspective, for the biggest names like Apple, there's almost nothing to worry about, and that's why they're able to price bonds at levels that are meaningfully tighter than initial price talk.
Okay, so one question there. I mean, why isn't Apple borrowing more? A question I have is, why aren't they being more creative with what they're using these proceeds on? I mean, buybacks, dividends, sure. But what about some M&A? Would we ever see that out of an Apple?
Sure. Let's just take one quick step back. From my first day of math camp, I learned you borrow when you can, not when you have to. Mm-hmm. And when you look at Apple's weighted average cost of capital, it is clearly skewed towards equity. Their cost of equity is about 10%. Their cost of debt on an after-tax basis is effectively zero. And that's why they continue to borrow so much. That's why they have $120 billion of debt. The question now really is, okay, are there better uses of that cash? I think if you look back at what Tim Cook said in the second quarter, so 3 months ago, he said size is not going to matter. And I think there's a variety of places that they can spend their money on if they can figure out a way to do it. There's small ticket items like buying the rights to the NFL Sunday ticket package. There's maybe a Peloton. They could buy wearables. But I think if you're really starting to think big, I mean, I don't think you can rule out names like a Netflix or following Microsoft's steps. They're trying to buy Activision, take down an EA. And if you really want to think big, start thinking about maybe something like a T-Mobile or a car company if they don't want to just build their own car. The real reason why they're not doing any of this in size, I think, is everything to do with the regulatory environment. I don't think the government wants to see Apple get any bigger, particularly via M&A. Yeah. And I think any large deal that they try would more than likely get blocked. So the simple answer is, the best returns on their capital, and they've got so much excess capital, is to continue to buy back stock. And by the way, since they're generating $100 billion of annual free cash flow, not cash flow, free cash flow, they're still going to have a ton in their kitty going forward. So they could always buy one of those big companies a year from now, 3 years from now, 5 years from now, depending upon what the regulatory environment looks like.
Robert, back to that first day at math camp, bond math camp. Can't wait to go there myself. Talk to us about who would therefore, with that mindset on, go to the market too.
Well, listen, there's a couple of deals that are M&A related that could use financing. First, there's Oracle bought Cerner. That deal already closed. That was $30 billion. We're waiting for financing there. They have a $15 billion bridge. Broadcom just announced that they were buying VMware for $60 billion, half funded with cash. There certainly could be a jumbo transaction there. And if you think about it, Microsoft, if Activision closes, they'll have spent over $85 billion on 2 transactions, and they could refuel and reload their kitty as well. So I think there's a potential for a massive amount of jumbo deals, particularly after a first half of the year where tech issuance is down 50% year over year.